A very good evening to all the participants of this webinar. Friends, we are continuing with DTRTI Lucknow webinars 2021, and in today's webinar we'll be studying part 4 of proprietorship non-manufacturing final accounts, being part of the bookkeeping and account series. And while doing final accounts, we are at illustration 6. And in this illustration, we have a trial balance before us of Messrs. Dayal Brothers, and this trial balance represents the balance figures as on 31st March 2017. So you can see the credit and debit balances, balance figures under various ledger accounts here. And we are supposed to prepare the balance sheet. So in order to prepare the balance sheet, we have to understand that which of these accounts will go into the balance sheet. So the accounts which are of the type of assets or of the type of liabilities or of the type of capital will find a place in the balance sheet. Of course, the trade inventory or the stock is also part of the balance sheet. So the balance sheet represents the capital, the liabilities, and the assets, which are intertwined by the accounting formula capital plus liabilities is equal to assets. So here we can see in the capital account there is a credit balance of 7 lakh rupees. So we add that into the capital account here in the balance sheet, and then to this the net profit has to be added, or if it is net loss, then that has to be subtracted. The net profit is given to us as a credit balance, which means that it is a profit. And in case there are some drawings, we have to reduce them from the capital account. So as you can see, the drawings of 60,000 rupees are being reduced here, and finally we get in the capital account 7,40,000 rupees balance, which is occurring below the amount heading in the respective column. So the resultant amounts will come into this column representing amounts. Then there is a 14% term loan, which means that a loan on which interest is payable at the rate of 14%, and it is a term loan, so that means that it has to be paid back within a certain time period or years. So therefore this loan will get terminated after a certain time, and therefore it needs to be paid back within that time. So the term loan amount is 4 lakh rupees, as is also seen here from the credit balance of 4 lakh rupees. Then there is a loan from Messrs. D and Company, 4,60,000 rupees. So this company has also given a loan, which is also entered here as a liability. Trade payables are to the extent of 40,000 rupees, and they are entered here. And on the asset side, we have the fixed assets, first of all, land and building, furniture, and trade inventories. So all these accounts we get, the balances of all these accounts we get here from the trial balance, the inventories, the furniture. Of course, the cash in hand will also find an entry here in the balance sheet on the asset side. The trade receivables will also happen to be on the asset side. Broadly speaking, the debit balances are supposed to be on the asset side, but sometimes certain balances are to be reduced from the other side, so that we have to take care of that. Just like net profit has to be added to the capital, and the drawings have to be subtracted from the capital. The advance which is paid to the suppliers is also going to be an asset for us, because we are going to get it back, or that person is a debtor. So that all these entries will find a place on the asset side. And finally, we find that just like the trial balance is balanced here, similarly we'll find that balance sheet will also get balanced at the end, because all the accounts that are mentioned here, they form part of the balance sheet, and therefore, as the trial balance is balanced, so is the balance sheet. Now, let us go to illustration 7. And in illustration 7, we have been given a balance sheet. And this balance sheet belongs to Thapa. And this balance sheet has been prepared as on 1st January 2017. As we have already seen, that balance sheet is prepared for a certain moment of time or for a certain day or end of the day. So it represents the positions of the assets and liabilities as at that particular moment. Now, we have been told in the question that during 2017, which is after 1st of January, because this is the opening balance sheet that has been given to us. And during 2017, the profit and loss account had revealed a net profit of 15,30,000. And this profit was arrived at after allowing interest on capital, the depreciation on the plant and machinery and furniture and fixtures, and after making a provision for doubtful debts at the rate of 5% of the trade receivables. The trade receivables which are seen in the accounts as on 31st December 2017. On that, at the rate of 5%, the provision has been made for doubtful debts. But at the same time, while preparing the profit and loss account, he had forgotten to provide for the outstanding expenses totaling 1,80,000 rupees. These were those expenses which are outstanding. So that means that expenses have been incurred, but they are not yet paid. And there is a prepaid insurance also that is not accounted for while preparing the profit and loss account. And the prepaid insurance is an advance, or we can say it is a insurance premium that has been paid to the extent of 20,000 rupees. So that is a sort of an asset. Outstanding expenses is a kind of a liability. We are also told that his current assets and the current liabilities were like this, like inventories were so much, trade receivables were so much, as on 31st December. Cash at bank was so much and trade payables were so much. And we have been told that he withdrew 6 lakh rupees for domestic use, which means that this is his drawing. Domestic use is non-business use, personal use. Now, on the basis of this information that has been provided, where initially the balance sheet has been given and finally we are supposed to prepare the balance sheet as at the end of the year, which means that as on 31st December 2017. We have been given the balance sheet of the beginning of the year, and after that we have been given certain facts and figures, and thereafter we have been told to prepare the balance sheet as on the last day of the year, which is in this case the 31st of December 2017. Now here, what we have been told is that we have to start from the beginning, that we are having a net profit of 15,30,000 rupees during the year. So therefore this net profit has to go into the capital account. Now, but at the same time, we have been also told that outstanding expenses and prepaid insurance has not been provided in the profit and loss account, and therefore our profit calculation is not yet complete till the time we provide for these. And so we are entering the prepaid insurance, we are crediting the the profit and loss account with a prepaid insurance, and we are debiting the profit and loss account with outstanding expenses. And having done that, we are getting a final net profit of 13,70,000 rupees. Now we have to understand this thing very clearly, that certain expenses have been incurred, that the money has flown out of the bank, but that was not accounted for in the profit and loss account. Similarly, money has flown out and in form of prepaid insurance. And since that is not an expenditure, that needs to be credited back here. So therefore, this is when we credit the profit and loss account, we are debiting the prepaid insurance account. And we are crediting the profit and loss account with the prepaid insurance. We are debiting the prepaid insurance account because when we had paid this amount, we had credited this prepaid insurance account here is being debited, and earlier we had credited it. So let us understand the prepaid insurance to the extent of 20,000 rupees. And then we, now that we have got the profit and loss account figure, we have to add this net profit to the capital. The capital is already mentioned earlier as 50 lakh rupees. If we look at the balance sheet, the capital is mentioned here as 50 lakh rupees. So we are rearranging it to put it on at the top, and we start with capital of 50 lakh rupees, and we add the net profit, and then we get 63 lakh 70,000 rupees, and then we reduce the drawings from it, and finally we get the amount of the capital. And then of course we add the interest on the capital, because the question, it has been mentioned that we have to allow the interest on capital at the rate of 6% per annum. So interest on capital is being added here. Is the interest being paid on the capital, so therefore it adds to the capital account. And then outstanding expenses to the extent of 1,80,000 have been provided in the balance sheet also, because this amount has been debited to the profit and loss account. As we can see here, the profit and loss account is being debited by 1,80,000 rupees, and credit is going to the the balance of these outstanding expenses account is moving into the balance sheet, showing a liability. Thereafter, trade payables are 11,40,000 rupees. That also we can check over here. The trade payables 11,40,000 rupees here. Of course, cash at bank will go to the asset side, and trade receivables will go to the asset side, and inventories will also go to the asset side. So we can see here cash at bank, starting with the most liquid, going to the least liquid. Sometimes we start with the least liquid and go to the most liquid. Then we started with fixed assets. So trade receivables, from the trade receivables, we are supposed to reduce the provision for doubtful debts. This has to be remembered very carefully. That provision for doubtful debts has to be reduced from trade receivables, and depreciation has to be reduced from the plant and machinery or from the fixed asset, whichever it is, like furniture and fixtures. The inventories are finding a place here, and prepaid insurance is an asset, because ultimately this is an investment that has been made, and therefore we are going to get it back. And since we are going to get it back, this is a sort of a receipt for us, and we can account it as a receipt or as an income in the profit and loss account. So in this way, the balance sheet is prepared, and what is important that is to be mentioned here, that 6 lakh rupees was for domestic use, so it has been treated as a drawing. And we have to understand one thing very, very clearly, that the expenditures, the balances of the expenditure accounts move into the profit and loss account, or they move towards in the trading account, and the balances of the income accounts move to the profit and loss account and the trading account, like sales is also moving to the trading account. And the balance of the profit and loss account finally is taken to the balance sheet. So whatever is taken to the balance sheet after being run through the trading and profit and loss account finds a mention ultimately in the capital account. But at the same time, there may be some expenditures which are mentioned in the profit and loss account, but they are actually not paid so far. So if there are certain payments that have not been made but incurred, they will be included while calculating the profits, but they will be shown in the balance sheet that this amount is yet to be paid. So out of the total capital, part of the capital gets invested into the assets, and certain liabilities are incurred which get paid during the course of the business, and these liabilities may also lead to formation of assets. So therefore, in the balance sheet, ultimately, the balances of the asset accounts, the balances of the liability accounts, and the balances of the capital accounts are reflected. And we always find that due to the double entry system, which the method by which we are making the double entries, the capital account, when added to the liabilities, will equal the assets. Because whenever we make a double entry, the one aspect of the entry will affect the balance sheet on one side, the other aspect will affect the balance sheet on the other side, as we have already seen while making the journal entries. So that is why this double entry system is a very beautiful system of accounting, because by making these double entries, we are side by side ensuring the accuracy of the accounts also to a great extent. So we have to remember another thing here, two important things here, that provision for doubtful debts has to be reduced from the trade receivables, and depreciation has to be reduced from fixed assets. The drawings have to be reduced from the capital plus net profit, and interest on capital is to be added in the capital account in the balance sheet. Now we move to sequence of the accounting procedure or the accounting cycle. Like, what do we do first, and then what do we do next while doing the accounting? Now we have seen so far that accounting process is like this, that first of all, we record the transactions in the journal, and we record the transaction or event in the journal, and that is called journalizing. For example, sale is entered into the sale book, purchase is entered into purchase book. And similarly, in the various journals that we are having, the transactions get recorded. So while recording these transactions, we record them by way of a double entry. For example, if a payment is made from the bank account, we credit the bank account, and depending upon to whom the payment is being made, that person's account will be debited. And in case it is a purchase or sale, we'll be debiting the purchase, and if it is a sale, then we credit the sale and debit the bank account in case the money is received. And in case the money is not received in case of a sale, instead of debiting the bank account, we debit the person to whom we have sold. So first step is journalizing. That means putting the double entry into the journal. The second aspect is preparing the ledger accounts on the basis of the journal or posting into the ledger. Now while making the journal entry, we are saying that this account has to be debited and this account has to be credited. This is called the journal entry, but then this journal into the respective accounts. So because when we are saying that we are debiting the bank account by 100 rupees, we have to put 100 rupees on the debit side of that bank account. That bank account is made in the ledger. So all the accounts are made in the ledger, and entries from the journal, every entry from the journal moves into the ledger in the respective account, which is mentioned while doing the journal entry. So all these journal entries get posted to the ledger. That is the language that is utilized or used. And finally, we have the debit and credit entries into the various accounts in the ledger, and we find out the balances of each account. And the balances of each account are put in a statement form with all the debit balances in one column and all the credit balances in another column. And that is how the trial balance is prepared. When you total the trial balance, debit side as well as the credit side, they should tally. If they are tallying, by and large, we can say that there is arithmetical accuracy. So trial balance is prepared to check for the arithmetical accuracy, but we can't be 100% sure because there may be many situations where trial balance may tally, but yet the account may not be accurate, as we have seen in various situations earlier. Finally, after preparing the trial balance, the trading and profit and loss account or the income statement for the period concerned is prepared. Now, and after preparing the trading and the profit and loss account, we prepare the balance sheet to show the final position at the end of the period. Now, we have to understand what are the opening inventories that are to be made whenever a business is started. So, whenever a business is commenced, we debit the cash account and credit the capital account with the amount introduced into the business. So initially some money is introduced into the business, and while introducing, we debit the cash account and credit the capital account. At the end of each year, the books are closed and new books are started in the beginning of every year. So whenever new books are started, the first entry in the journal is to record the closing balances of the assets and the liabilities at the end of the previous year or the earlier year, and these are recorded as the opening balances in the beginning of the new year. So the balance sheet which is prepared at the end of the year has the record of the balances, and all these balances in the balance sheet are taken forward to the next year and they are the basis for the first entry, and it is called the opening entry. So opening inventory constitutes taking of the balances from the balance sheet of the ended year and taking them forward to the new year. Now, as a matter of illustration, we have a balance sheet here, starting in the asset side from the least liquid, also the maximum liquid asset, to the least liquid asset. And on the basis of the information given in this balance sheet, which is as on 31st December 2017, we have to prepare the relevant opening inventory. So as we have said, the opening inventory is prepared by transferring the balances of the previous year to the next year. So all the debit balances are on the asset side, and all the credit balances in the balance sheet are on the liability side. Therefore, for transferring these balances as a form of the opening inventory, we will be crediting these accounts which are on the showing the debit balances. We will credit them so that they are closed, and we'll debit the same name accounts by the same amount. So starting with the opening debit balance, as we can see here, all the debit balances are shown here, and then they are all totaled, and finally we are seeing the Mahindra and Sons account and capital account. So as we can see, Mahindra and Sons account and the capital Mahindra and Sons account is a loan account. So capital account is a capital introduced by the proprietor. So in this way, the capital account and the Mahindra and Sons account are on the liability side, and they were having credit balances. So we debit those accounts and we create new credit balances in the new accounts which we start in this new year. So Mahindra Sons account and capital account is a newly opened account for the new year, in which these entries are coming in. So this is the opening inventory, and once the opening journal entry is prepared, then that will be posted ultimately into the ledger. Now we know that all the assets which are showing the debit balance, all the assets show the debit balances only. So in that respect, whenever a new account is opened and it is a debit balance, so we started with two balance brought down. So two balance brought down is because it is a debit entry made on the debit side of the cash account, and this is the entry which is made at the beginning of the new year, showing the opening debit balance in the cash account. And similarly, just like cash for other assets, also similar accounts are opened, and the relevant amount in the journal is posted on the debit side. Now the accounts of the liabilities show credit balances, and therefore they are brought forward as by balance brought down because they are entered on the credit side of the new account. Now once we have posted the opening entry completely, all the accounts of the assets and all the liability accounts in the beginning are now opened. So that is how the opening entry is made. Now let us see a new illustration. It's called illustration 9. Under the illustration 9, Sri Mittal has given us a trial balance, and this is the trial balance before us. There are debit balances and there are credit balances. Now, when we look at the debit balance in the advertisements account, we know that this is the advertisement expenditure that is made. Similarly, other expenditures show other expenditure which has been made. Now, how the debit balances have appeared here? Because whenever we make an expenditure, we credit the bank account because we make the payment, and we debit the expenditure advertisement account. That is how these debit balances are coming there. And finally, they are finding a place in the trial balance. Now, when we say returns, it means sale return and purchase return. If it is a debit balance, it means that it is a sale return. If it is a credit balance, it is a purchase return. And finally, we have been told that the closing inventory as on 31st March 2017 was 1 lakh rupees. And we are asked to make final accounts. Whenever we are asked to make final accounts, first of all, we have to make the trading account, then we have to make the profit and loss account, and then thereafter we have to make the balance sheet. So in order to make the trading account, first of all, we need the opening inventory, the purchases, the purchase returns, the sales returns, and the closing inventory, and any other direct expenses for the trading. Of course, in this example, we don't have any direct expenses of the trading. So we take all these figures are readily available here in the trial balance, as you can see. So it's easy to prepare the trial balance. The opening inventory is 72,000 rupees. So we can see the opening inventory here, 72,000 rupees. The closing inventory has been already given to us 1 lakh rupees. So closing inventory is taken as 1 lakh rupees. Finally, we get a gross profit by reducing the debit side from the credit side. And this gross profit is carried forward to or brought down to the profit and loss account by debiting the trading account as it is being debited and crediting the profit and loss account. Thereafter, the profit and loss account is debited by various items of expenditure, and thereafter the right side is, and the right side minus left side is or the credit minus debit is the net profit, which is 1,83,000 rupees in this case. And then we have to prepare the balance sheet. So when we have to prepare the balance sheet, we have to take this net profit and add it to the capital. And all the rest of the entries are taken from the trial balance and entered into either the asset side or to the liability side, depending upon what kind of balance is there. If it is debit balance, it is put on the asset side. Otherwise, it is put on the credit side, liability side. And the loan, the 14% bank loan, it has been taken at the year end. So this 2 lakh loan has been taken at the year end, and overdraft is also taken at the year end, 1,12,000 rupees. So two of the amounts, this 2 lakh and 1,12,000 rupees, are shown here in the liability side, but no interest paid is going to be shown here because these loans are taken on the last day and therefore no interest is accrued. If the loan had been taken earlier, the interest accrued would have to be accounted for. Now, illustration 10. Mr. Mohan gives us a trial balance and some other information. So this is the trial balance, and thereafter we have the closing inventory, and furniture depreciation has to be allowed at 10%, and we are being asked to prepare the final accounts. So in this situation, we have to identify very clearly that in the trading account, we have to, this freight inward, because whenever we make some purchase, we pay for the freight. And when we pay for the freight, in case we pay for the freight, then we have to add it into the trading account. And we not to the profit and loss account. The freight inward is to be taken in the trading account, as has been taken in this case. So other entries in the trading account are opening inventory, closing inventory, purchase returns, sale entry returns. The purchase returns have to be reduced from the purchase, and sale return has to be reduced from the sale. Finally, the difference of both sides is the gross profit, and then the gross profit has to be carried forward to the profit and loss account. And there we add the other accounts depending upon their balances, whether they are income or expenditure accounts. If they are in the nature of expenditure account, they are put into the debit side of the profit and loss account. Their balances are put on the debit side of the profit and loss account by crediting those accounts and debiting the profit and loss account. And finally, even the bad debts are put on the debit side of the profit and loss account. The discount which is received on the trading activity, that is put in the profit and loss account. Idea is that discount may not always be received, so we must know what is our trading margin without the discount. Sometimes the discount may be there, sometimes discount is not there. So without the discount, as a matter of prudence, we want to find out what is our gross profit margin. That is why discount received is credited in the profit and loss account, so that we do not overstate our incomes or do not overstate our trading results. And then, of course, the balance sheet, as we have already seen, all the items of asset and all the items of the liabilities are put in the balance sheet, while taking care that the net profit which is calculated here in the profit and loss account, this will go as an addition to the capital. And all the other usual entries will be made and the balance sheet will be prepared. Now in the illustration 11, this is a question where the balance sheet is already there. It has been given to us of Mr. Popatlal, Mr. Popatlal being a merchant, and the balance sheet as on 31st March 2017. So the balance sheet is given to us. We have to show the opening and inventory. As we have said, that all the items in the balance sheet are transferred to the next year new accounts in the new books, and therefore new accounts are all made in the name of the assets and the liabilities, and all the liabilities are transferred there, even the capital is transferred there, by way of making the opening inventory. So as we can see here, the opening inventory is being made here, and all the debits are taken by debiting the respective accounts in the new accounts, and all the credits are taken by crediting the respective accounts. As simple as that. So that in case of trade receivables, we are seeing here that though in the balance sheet we are reducing the provision for doubtful debts from the trade receivables, but here we are debiting the trade receivable by 1,88,000, the original trade receivables, and as far as provision is concerned, that is credited here. So that is shown separately. At the end of the year, when we prepare the balance sheet, we'll reduce it again from the trade receivables. I mean the provision for doubtful debts. We'll reduce from the trade receivables at the end of the year, not at the beginning of the year. Now, the next is illustration 12. And this is showing a schedule of the balances, or the trial balance, you can say, extracted from the books of Sri Gavaskar, who is having a business under the name and style of Messrs. Gavaskar Vishwanathan Company from Bombay. We have been given the balances of the accounts. In a way, what we are being given here is a trial balance, and we have to prepare the trading and profit and loss account for the year ended 31st March 2017, and the balance sheet has at that date also. But before that, we have to make certain adjustments. Making provision for the following means we have to make those adjustments, like the depreciation. The building is used for business, we depreciate that by 5%. Furniture and fixture has to be depreciated 10%. Steel table, which is purchased during the year, has to be depreciated for. It has been purchased for 14,000, was sold for same price, but sale proceeds were wrongly credited to sales account. So therefore, this needs a correction here. And office equipment has to be by 15%. Thereafter, this is all depreciation, office equipment by 15%. Typewriter is purchased during the year for 40,000 rupees. It is wrongly debited to purchase. So we have to take it out from the purchase and enter it in the fixed assets. Motor car has to be depreciated by 20%. Stock value is given at the close of the year. And in terms of rent, the godown rent, which is outstanding, is 2 months' rent. It is outstanding rent, not yet paid. Interest on loan has to be provided for at 12% per annum. This loan was taken on 1/5/2016. And reserve for bad debts is to be maintained at 5% of the sundry debtors. So, and the insurance premium, which includes 40,000 paid towards the proprietor's life insurance policy. That means this proprietor's own policy, and that therefore it will be treated as a drawing. And the balance of the insurance charges covered the period from 1/4/2016 to 36/2017. So, which means that we have to prepare the profit and loss account as then the balance sheet as on 31st March 2017, and therefore the insurance charges cover the period of 1/4/2016 to 36/2017, which is a period which is of more than 50, which is about 15-month period. So out of this, we have to take only the 12-month period, the relevant period. So as you can see, first thing that we have to prepare is a trading account. So in the trading account, one by one, we have to identify which entries belong to which account, like trading account, balance sheet, or profit and loss account, and accordingly take them to the respective account. Reserve for bad debt is to be maintained at 5% of sundry debtors. So we have to maintain this reserve. We have to debit the profit and loss account and credit the reserve for bad debt account. So the opening stock is shown as 6,20,000. Purchase is there, and typewriter, which has been included in purchase, is reduced from the purchases because it has to be taken into the balance sheet straight away as an asset. So we are reducing typewriter from purchase, and we are reducing purchase return also. And finally, we get a purchase of 13,34,000. And then, of course, there is a freight has been paid. So therefore, 12,000 freight is accounted for in the trading account. The sale of furniture included in the sale has to be reduced because it was wrongly included in the sale, and furniture has to go into the balance sheet, and closing stock is of course entered here. So that's how we get a trading profit of 7,18,000 rupees, which is carried forward to the next year by gross profit brought down. And out of the rent of 55,000 rupees, 11,000 rent is still outstanding. So the rent which is paid is 55,000 rupees, but 2 months rent is outstanding, so we'll account it in the profit and loss account. So therefore, when we look at the rent, it is rent for godown 55,000 rupees, and we have been told that 2 months of rent is still outstanding. So we calculate that as 11,000 rupees, and we add that to get a total rent of 66,000 rupees for the whole year. So to understand this more clearly, we can have a look at the rent for godown. Rent for godown 55,000 rupees here, and 2 months rent for godown is outstanding. So we have to calculate the 2 months rent for godown, and therefore that is we calculated here, because 2 upon 12 is 1 upon 6. So total rent is 66,000. So 1 upon 6 is 11,000. Therefore, we have to total the rent up to 66,000. So that is how we are treating the rent at 66,000. The provision for doubtful debt is created by debiting the profit and loss account. Similarly, all the other expenditures that have been incurred are mentioned here, and discounts are mentioned, which are received, are mentioned on the income side. And as you can see, all the other items, including depreciation, is to be entered in the profit and loss account on the debit side. Finally, the difference between two sides is net profit, and it is transferred to the capital account, is added to the capital account here. And drawings have been reduced at 1,20,000 rupees. And of course, the insurance premium that is paid for the proprietor personal insurance, that is also reduced, because that is not part of the capital, that is a withdrawal being made out of the capital account to buy the insurance premium. Of course, all the other accounts where depreciation is to be reduced from the fixed assets, that is also being done here. Stock in trade has been already given at closing inventory 4,40,000 rupees. Provision for doubtful debt is reduced from the sundry debtors. And finally, the prepaid insurance is mentioned there in the asset side as a debit balance. So that is an asset that we are going to get back. So depreciation is accordingly calculated. Interest on loan is to be also calculated in this case, which is loan is 3 lakh rupees, so interest will be at the rate of 12% for 11 out of the 12 months will be so much, and from that we have to reduce the interest as per the trial balance, and thereby we get a outstanding interest of 6,000 rupees. The provision for bad and doubtful debt account or bad debt account is shown here. This is a balance brought forward 30,000 rupees, and we are incurring new bad debts. And finally, we are creating the provision account by debiting the profit and loss account to create a provision. So this is a 33,000 fresh provision is being created. And finally, we are getting a provision of 43,000 rupees in our accounts, which we carry forward. So with that, we come to the end of part 4 of final accounts, and we continue the story with part 5, and I think that will be the last part of the final accounts, and we start that with provisions and reserves. in the morning at 8 a.m. So please join us for the next session at 8 a.m. tomorrow morning for last and final session of final accounts of the non-manufacturing entities. Thank you very much for having joined this session.